Something just snapped in the foundation of this market. Not in the price action yet, but in the psychology underneath it. Fund managers are at their most bullish positioning in almost a year. At this exact moment that liquidity is showing drying up, AI spending's going parabolic, and Fed officials are describing themselves as having lost visibility on the economy. And when you get this setup, it builds a lot of pressure underneath it. Today's data, survey results, liquidity reads we look at, they all kind of point to the same direction, that something big is brewing. And the market's reaction, it reflects that. So let's talk about everything that's changed. So sentiment's really shifting towards this, we're at a peak of confidence right now. Because the Bank of America Global Fund Manager Survey, it's this survey of 172 managers, collectively $475 billion under management. The most important numbers in this entire report comes under those fund managers' positioning, their allocation to cash. So cash levels are at 3.7%. That's the lowest in 15 years. And this number's only happened 20 times since 2002. Every single time that's happened, stocks fell and treasuries rallied over the next 3 months. So when treasuries rally, that's like, think treasury bonds or TLT stock, for example. When TLT stock goes up, the yields fall on those treasuries. Rates follow treasuries, so rates fall, and stocks also fall. Even though the economy's easing. But this is every single time, not just usually, not often, every single time this happens. And at the same time, managers are the most overweight they've been in since February. So if stocks continue moving down, what if these fund managers flip from bullish to bearish? But anyways, global growth expectations turned positive for the first time this year. Soft landing expectations jumped to 53%. Commodities overweight in the highest since 2022. So this mood that we're seeing, it's the kind of mood that you'd imagine at the top of the cycle. And the biggest tail risk that B of A sees, it's not inflation, it's not geopolitics, it's AI and this potential AI bubble. Which leads to the next problem, which is AI capex. So this spending, it's really getting out of reality. Goldman says that mega cap tech is now pouring 95% of operating cash flow into capex. So they're pretty much working, making this money, and they're pouring it into AI, which is pretty much like lighting money on fire right now. But AI is being the main accelerant of what we're seeing with this operating cash flow into capex, buybacks, dividends. It's up 80% from 2019. And then we get the monster partnership right here. NVIDIA, Microsoft, and Anthropic. This is a $45 billion loop of capital and compute. NVIDIA takes this $10 billion stake. Microsoft puts up $5 billion. Anthropic commits to buying $30 billion of Azure compute built on NVIDIA chips. Anthropic's valuation, it's roughly around $350 billion, but this just mirrors everything happening with AI and money flowing in circles, obligations stacking up, compute spending exploding, and these investors praying that one day revenue actually catches up and justifies it. But this is the real kicker right here. AI infrastructure requires 6 times more capital to create the same economic value as the original cloud build out that already exists. So for every dollar spent today, estimated net present value is at 20 cents. So down 80%. Mature cloud, so people who's kind of like figured it out right, about $1.40 return per dollar. So there's not really this patience for this kind of math, and it's wearing thin. And it shows that there's this hesitation that you're seeing under the surface, especially with where certain valuations of certain assets and sectors have gone so far. And then when you look at the real economy, we have these cracks showing where it really hurts and it kind of like spreads. So while tech is burning and burning cash, that is, to chase AI and kind of build out the replacement of human labor in the future for some of these jobs, and yeah, it might create 10 jobs or whatnot, but that won't be anytime soon. This more old school point of view of the economy, it's quietly freezing up. So we get into looking at Home Depot earnings today. And yeah, you might not watch stocks specifically, but what they say about guidance, that's where it gets important. And Home Depot cut guidance. They reported lower profit, not because of some crisis, but because homeowners are just flat out scared to spend money on big projects. So these kitchen remodels, that new roof, the bathroom demo, all of that's being delayed. And then think about the velocity of money where when $1 spent, that dollar might touch 7 other hands. So like when you get a bathroom remodel done, like the people who make toilets, and then the people who order the supplies to make the toilets, and then the workers that like deliver them, and then like that's truckers, and then the fuel, and then insurance companies for the, it's just like a long chain all the way to the person who pays their light bill with it. And the CFO of Home Depot says that customers are on the sidelines because of this economic environment that we continue talking about, and how it's so uncertain, and that these big ticket finances, like financing some of these larger ticket purchases, it really doesn't make sense, just because inflation's kind of ran. And even though the numbers have cooled down, just because inflation hypothetically went to 1% or 0%, that doesn't mean prices fell down to what they were 10 years ago. They're just not going up, or they're going up at 1%. So this is the exact kind of slowdown that feeds into this Fed's picture, where things are getting even more interesting. So as far as the Fed visibility we were discussing earlier, they're basically admitting to flying blind, at least in one Fed official's point of view. And this is Thomas Barkin. He's the president, Federal Reserve Bank of Richmond. And he laid the whole situation out here. And what he pretty much says is the Fed's operating with limited data. The lighthouse is off. The shoreline is invisible. And right now they're just kind of like navigating slowly, trying to figure out what's going on. And this is due to these shutdown disruptions. It really broke the flow of official numbers. So the Fed's more reliant on right now like private data, like credit card data or ADP surveys, direct business outreach across the 5th district. And what that kind of data is showing is this K-shaped economy that we talked about in a few other videos, where the economy's recovering differently and unequally. Like this higher end consumers doing really well, and then middle to low income consumers are really struggling right now. We got these data centers and energy, and like I said, rich people who own stocks, Wall Street, pharma, construction, these high income households all doing good. And then farmers, real estate agents, depending on who your agent is, tariff exposed manufacturers, low income consumers, people in the DC region. It's really tough. And then demand is still at this healthy top, is how it's described. It's sluggish at the bottom though. Then you get to talking about the labor market. Yeah, unemployment's at 4.3%. It's still low. But then you look at job growth, and that's only added 29,000 jobs per month. And then ADP's weak at 42,000 job postings, drifting lower. Layoffs rising at some of these big firms. And then at the same time, labor supply growth is structurally falling. Aging workers, slower immigration, projected labor force growth collapsing from 0.8% to 3.3% over the next decade. So you've got this cooling demand plus shrinking supply, and that equals a slowing labor market without a spike in the unemployment rate. And then inflation, this CPI at 3% headline and 3% core. It's being above the Fed's target is kind of what they talk about. You got shelter cooling, oil cheaper, non-housing services, and then those are what's cooling. And then some of these hot ones like insurance costs being still elevated, and then businesses saying inflation is still elevated but it's stable. And these consumers are really beginning to push back, is what Barkin begins talking about, and how they're switching to these private label brands and repairing rather than replacing, and making trade-offs. But and once you get into productivity, including early AI use, it's helping keep these costs in check just a little bit for the people who's become a little bit more savvy with the AI and building it into their business. But the policy tone from the Fed is that they're not in a rush, and Tom Barkin doesn't think they need to rush, and they're not about promising anything either. They don't want to force a move with visibility this low, so they're slow, they're cautious, collecting real-time anecdotes, and that's their substitute for this missing data. And he really didn't want to commit to talking about any cuts or anything regarding that. It's just like, hey, we're going to keep on looking at the data and we'll react accordingly because we can't see very far in front of us. So that was our main takeaway from Mr. Barkin today. And that goes into today's ADP print, which didn't give them a single reason to cut once we got into that, because we got that one early. But we'll talk about that here in a bit, because liquidity is really the risk nobody's considering right now, and nobody's talking about this enough, because all of this sits on top of a huge structural issue where liquidity is thinning out, and it's doing so very quickly. So Wells Fargo says that October saw the fastest liquidity drain since 2022. And when liquidity dries up, the most speculative assets, those are the ones that fall first, which explains Bitcoin and some of these high beta tech names and this sudden fragility in risk assets. So bank reserves have dropped to $2.85 trillion. That's the lowest in 4 years, thanks to QT, quantitative tightening. And banks borrowed $110 billion from the Fed's standing repo facility. That's the highest on record. But still, it's tiny compared to the $3 trillion in daily repo trades. So banks may be hoarding liquidity to avoid realizing $400 billion in unrealized losses. This isn't crisis territory, but it's one shock away from stress, which brings us to another quiet source of volatility. So a new Reuters a poll shows that 65% of Americans disapprove Trump's handling of cost of living. That disapproval has jumped dramatically throughout the year. People still feel like this inflation is too high, and even when CPI cools, it still kind of feels like heavy on people's shoulders. And that behavior reflects that more trading down we're seeing for the consumer, more private label purchases, fewer big purchases, more repairs, more personal trade-offs, which reinforces sticky services inflation and feeds into the unevenness that Barkin really described throughout his speech today. And the missing jobless claims because of the government shutdown, the jobless claims data, it's missing 6 weeks of data, and we have only one clean print, and this one was complete accident. So even on here, it's like some weird name report. It took me forever to find it earlier, but you go to this little spot, you just put the range right here. So 2025, it'll let you put 2026. We just want to see this one part. And what we see is that if we scroll all the way down, we skipped a couple weeks before it. There's nothing after it yet, but we have only 232,000 on October 29th. And they admitted that this was an error and promises that we'll get the rest of this data out on Thursday. But before that, before we even get to Thursday, we got Nvidia earnings and the Fed minutes tomorrow. So tomorrow's going to be a big one, both landing while the labor picture's incomplete, and that's not great timing. And now, how did the markets react to all this? Because we kind of talked a lot today, and that global fund manager survey, it really hit the market on the head today, literally. because all of them went swirling. Positioning was showing extreme liquidity tight, this AI capex overheating, the cracks in consumer spending, low visibility for the Fed, this sentiment showing dropping, and data being incomplete. The market's responding to all of that. And what we've seen is for the NASDAQ, it was down 1.21%. The S&P 500 down 0.83%. The Dow Jones Industrial Average down 1.07%. This is tracking up to be the worst November since 2008, the subprime collapse, subprime mortgage collapse. But, I mean, despite all of that, Bitcoin, I mean, this one was a gainer today, up 2.97% off of yesterday's slam, but still 26% off of its highs, which is considered a bear market territory, because a bear market territory is like 20% from its it dropped 20%, and a correction's more like down 10%. And when we look back at this S&P 500, 324 S&P names are already in that correction territory. So that's strong market breadth in a certain direction, right? And that direction's down. 4 of the Magnificent 7 are in correction or bear territory. We only have one in that bear territory. It's Meta. That one's been... That's the one that the market was hit on the head with. Amazon, Nvidia, Tesla, those ones are all down double digits from their recent all-time highs, being down 10%. So they're who are classified in the correction territory. And this isn't a narrow problem anymore either. It's pretty broad, and it's fast, and it really lines up with everything building underneath the surface, which is just a stage setting for higher volatility, because this pressure is high. And we got catalysts that are coming out tomorrow. And then another one the tomorrow after tomorrow. That jobs report's going to be a big one to watch on September jobs report on Thursday. Because the Fed minutes, like, yeah, we're going to know how divided the Fed was and everything. But at the same time, there's been a lot of like cloudness and change since their October meeting. We're looking at December 10th now, and what they're going to do with the rates, and what they have to say about what they're going to do with the rates, and their forward guidance on the economy. So we'll keep on watching this, everybody. I'll be sure to report whatever comes out tomorrow, and for sure Thursday and Friday. I've been pretty consistent, so like, just because I've been consistent, and I appreciate you. And I appreciate you for watching. So I'll get out of here. I'll let you have a good one. Enjoy your night, and I'll see you.